Citibank just dropped a $150 silver price target, but buried inside that report is a detail that changes the math for every single silver stacker watching this. Citi didn't just pluck that number out of thin air. They have supply data that the public doesn't have. And when you see what's driving their target, you'll understand exactly why the move from $76 to $150 is not just possible, it's inevitable. Here's what makes this different than other silver price predictions you've heard. This isn't a crypto influencer making speculative guesses. This is a major investment bank with access to supply chain data, industrial demand data, and vault inventory data. And they're saying silver at 150 doesn't just happen. Silver at 150 happens because of a supply squeeze that's already in motion. Silver is currently trading at approximately $76 per ounce. It was at $40 just 3 years ago. The move from 40 to 76 is already a 90% gain. Most people think that's the run. They think silver is done moving. But Citi's analysis suggests the real move is just beginning. And the reason is structural supply deficit that nobody is paying attention to. Here's the context that makes this significant. Industrial demand for silver has exploded. Renewable energy systems, solar panels, electric vehicles, 5G infrastructure, all of it uses silver. Global industrial silver demand has grown 30% in the last 5 years, and that's accelerating. But supply? Supply is flat. Mining production is stagnant. COMEX inventory is at multi-year lows. And here's the part that changes everything. The US has virtually no silver reserves left. The Strategic Petroleum Reserve for silver, they sold almost all of it in the 80s. The supply crisis Citi is pricing in. Citi's report doesn't come out of nowhere. Their analysts have access to mining production data that retail stackers don't. They track secondary supply, recycled silver from industrial processes. They know what's happening with COMEX inventory, and they're saying the math only works at 150 or higher. Here's the supply picture. Global silver mining production, primary silver, is approximately 28,000 metric tons per year. That's been flat for the last decade. You'd think it would grow with higher prices. It doesn't. Why? Because most silver is a byproduct of copper, gold, and zinc mining. And copper mining economics don't care about silver prices. Secondary supply, recycled silver from industrial processes, adds another 6,000 to 8,000 tons per year. But that's dependent on industrial production. During recessions, industrial recycling drops, and industrial production is already slowing. So total supply is roughly 36,000 metric tons per year. Demand. Industrial demand is 30,000 metric tons per year, and growing. Photography demand, which was massive historically, is nearly zero now. Investment demand fluctuates, so structural demand is roughly at supply levels, but any disruption in supply sends the market into deficit. Citi is pricing in exactly that scenario, a supply disruption. And when a supply deficit market gets disrupted, prices don't move 10 or 20%. They move in multiples. Silver at 150 is their pricing model for a supply deficit that persists for at least 18 months. The hidden detail in Citi's analysis. Here's the part I mentioned at the beginning that changes everything. Citi's report includes data on central bank silver holdings. And here's what most people don't realize. Central banks don't hold much silver. They hold gold. They hold currency reserves. Silver, it's not part of the central banking system, but there's one place that holds massive amounts of strategic silver, the US government. Specifically, the Defense Logistics Agency holds a strategic silver reserve. It's not publicized. Most people don't know it exists, but it's the backup supply that could theoretically be released if the US needed silver for critical infrastructure. Citi's analysis suggests that reserve is being quietly discussed at the Federal Reserve and Treasury, not because they want to sell it, but because the possibility of selling it, or the government restricting exports, suddenly becomes a policy tool if silver prices get out of hand. Now here's where it gets interesting. If the government is considering silver policy because supply is that tight, what does that tell you about the actual market situation? It tells you supply is genuinely constrained, not speculation, not hype. Actual policy consideration. That's Citi's signal that this is real. Why stackers are going to make life-changing money. Let me put this in perspective. If you're a silver stacker with 100 ounces, at $76, you have $7,600. If silver moves to 150, you have $15,000. That's 100% gain. That's real money that changes positions. But here's why stacking is so powerful compared to trading. When silver moves from 76 to 150 over 18 months, it doesn't go in a straight line. It grinds up with pullbacks. Traders sell at $80 thinking they got lucky. They sell at $100 thinking it's the top. They miss the 150 print. Stackers don't care about the up and down. They accumulate consistently. They hold through volatility. And when the repricing happens, when silver hits 150 not as speculation but as supply-constrained reality, the stackers who've been accumulating for the last 2 years are sitting on massive wealth. The stackers who understand the supply story, who know why COMEX is low, why demand is growing, why government policy is starting to care about silver, those stackers hold, and they're the ones profiting from Citi's 150 target. The timeline for repricing, Citi didn't say when silver hits 150, but their supply analysis and industrial demand growth suggest it happens within 18 to 24 months. We're in April 2026. That means repricing window is roughly April 2026 to April 2028, most likely concentrated between now and end of 2027. Why? Because industrial demand grows continuously. Solar installations are increasing. EV production is accelerating. 5G deployment is ongoing. None of that demand disappears, it only grows. And supply can't grow fast enough to meet it. The first phase of the move, where silver accelerates from 76 to 100, probably happens in the next 6 to 9 months. That's when institutional money starts noticing the supply squeeze. The second phase, 100 to 150, is probably the latter half of 2027 and early 2028. But these things are never perfectly linear. There could be an acceleration if a major mine shuts down, or if governments announce silver reserve policy decisions. When that happens, the repricing could compress into months instead of years. What Citi's target means for your stack. If you're holding silver and you believe Citi's analysis, the question becomes simple. Do you sell at 85 when the market has a bounce? Do you sell at 100 when you're up 30%? Or do you understand that the repricing engine hasn't even started yet and you hold for the $90, 105, 120 moves? I'm not telling you to do anything. That's your research and your decision. But historically, when institutional players like Citi publish targets this aggressive, they're based on data that hasn't been fully priced in yet. The market's surprise is ahead of you, not behind you. The stackers who understand this hold through every bounce and every pullback. They're not watching the daily chart. They're watching COMEX inventory data. They're watching industrial demand reports. They're watching policy discussions. That's where the signal is. That's how you know when repricing is imminent. The broader context beyond Citi's target. Citi's 150 target doesn't exist in isolation. It exists because every major commodity researcher is seeing similar supply-demand imbalances. Goldman Sachs has a bullish gold target. BRICS nations are buying physical silver and gold. Central banks are shifting away from dollar reserves. Silver is caught in the center of a structural shift in the global monetary system. Supply deficits, geopolitical uncertainty, central banks moving to hard assets, industrial demand that can't be met from current production. When all those factors align, commodities don't move 30%, they move multiples. Citi's 150 target is conservative relative to what could actually happen if any of these structural issues accelerate. So if you're a stacker and you just learned about Citi's analysis, start tracking the data yourself. Check COMEX inventory reports monthly. Watch industrial demand statistics. Follow geopolitical news about commodity supply. That's how you know when repricing is imminent, and that's how you position to profit from it. What nobody is telling you, the EV and solar demand multiplier Citi doesn't advertise. Citi's official report cites industrial demand numbers. But the analysis I'm going to give you right now goes deeper than what appears in their published target, because industrial demand growth for silver is not linear, it is exponential, and exponential demand growth against a supply-constrained base creates price dynamics that look nothing like normal commodity pricing. Here are the specific technology demand numbers. A single solar panel uses approximately 20 grams of silver in its photovoltaic cells. Global solar installation is projected to add 2,000 gigawatts of new capacity by 2030. 2,000 gigawatts divided by roughly 300 watts per panel equals 6.7 billion panels times 20 grams per panel equals 134,000 metric tons of silver demand just from solar installations in the next 4 years. For context, total global silver mining production is approximately 28,000 metric tons per year. Solar demand alone over 4 years requires more than the entire world's silver mining output for the same period, and that's before electric vehicles. A single EV uses approximately 40 grams of silver in its electrical systems. Global EV production is projected to reach 50 million units annually by 2028. That adds 2,000 metric tons per year just from EVs. Now stack 5G infrastructure deployment, medical imaging devices, and semiconductor fabrication on top of that, all growing, all silver intensive. None of them can substitute away from silver economically. And even if silver prices doubled tomorrow, the permitting and construction timeline for new mines is 3 to 7 years minimum. Supply cannot respond to price signals fast enough. Citi's $150 target assumes persistent supply deficit. The actual demand trajectory suggests 150 may be conservative relative to the structural forces already in motion, the 3 signals that tell you repricing is imminent. I've given you the structural case for silver repricing, but structural cases play out over time. The question every stacker asks is, what observable signals tell me the repricing window is opening right now? Here are 3 specific indicators you can track weekly. Signal 1, COMEX registered silver inventory drops below 150 million ounces. COMEX currently holds roughly 300 million ounces in registered stock available for immediate delivery. When that drops below 150 million, supply is being drawn down twice as fast as new supply enters. At that rate, COMEX has 6 to 9 months of delivery capacity before going critical. Check the COMEX weekly silver inventory report. It's public and free. Signal 2, silver lease rates spike above 2% for more than 2 weeks. When dealers need to borrow silver to fill orders, they pay lease rates. Normal is 0 to 0.5%. When rates spike to 2% or higher and persist, it means dealers are paying a premium to borrow because they can't buy. That's peak scarcity signal. Banks are rationing the metal they manage. Signal 3, US dealer premiums exceed 15% over spot for more than 3 consecutive weeks. Right now, US dealer premiums are roughly 3 to 5% over spot. Normal, when premiums hit 15% and hold, even the most accessible physical market on Earth is constrained. The repricing that follows happens in the next 30 to 60 days. When signal 1 and 2 fire simultaneously, repricing is beginning. When all 3 align, it's already happening. Track these numbers weekly. They are the most precise, data-driven signal available for precious metals repricing, and they are publicly accessible without any subscription or institutional access. One final point worth emphasizing, Citi's $150 target doesn't require anything unusual to happen. It requires the existing supply deficit to persist for 18 months, while industrial demand continues at current growth rates. Both of those things are essentially guaranteed, unless major new mines come online in the next 2 years, which the permitting and construction timeline makes physically impossible. If this analysis helped you understand the supply story behind silver prices, subscribe for daily silver tracking. When repricing signals fire, I'll be breaking down exactly what they mean so you can position accordingly. Drop your silver stack size in the comments. How many ounces are you targeting before repricing hits? Are you accumulating more now or waiting for a pullback? Let's see where the stackers' positions are. Smash that like button if you're impressed by Citi's analysis and want this message reaching other stackers who are only focused on price instead of the supply dynamics driving it